Hi CA students, let's revise CA Final AFM Chapter 3 Advanced Capital Budgeting Decisions. Practical question 7. Following are the estimates of the net cash flows and probability of a new project X Limited, and they have given initial investment and probability for initial investment also they have given, but as you can see it is same for all. That means anyway before investing in an investment we'll obviously know how much it will be. So even if you multiply with the probabilities you will end up with the same amount. And estimated net after tax cash inflows per year for 1 to 5 years they've given three values, and we have to multiply with the probability to get the expected cash flows. Since for 1 to 5 years the expected cash flow is going to be same, we can take annuity factor also for the discounting. And salvage value they've given after tax at the end of fifth year. Again this also we have to multiply with the probability to get expected salvage value, and then we have to multiply it with the fifth year discount rate. Then we can arrive at the NPV as it is the first requirement. Then they are asking best case and worst case NPVs, so that also we'll see. Then the probability of occurrence of worst case if the cash flows are perfectly dependent over time and independent over time. The worst case scenario is decided by when we have the least cash inflows. So in the three cases which are given, we can see the 30% probability case has the least cash inflows, so that will be the worst case. And the probability of occurrence of the worst case is 0.3, and if the cash flows are perfectly dependent over time then the probability will be 0.3 itself. It will remain 0.3 for all the 5 years, but if it is independent over time then we will not be able to definitely say it is 0.3. so in that case we have to multiply it for all the years. So it will be 0.3 into 0.3 into 0.3 into 0.3, which will be for 5 years. So we can say 0.3 to the power 5, so which will come up to 0.00243. that will be the probability of occurrence of the worst case if the cash flows are independent over time. So if it is dependent over time then the probability will be same for all the years, there won't be any change. And if it is independent then we have to multiply the probability with itself for the number of number of period. In our case it is 5. So going to next, the standard deviation coefficient of variation, assuming that, okay, before this first we'll just see the three answers, then we'll come up here for the fourth and fifth one. So the first one, as they've asked expected NPV of the project, which we have previously seen, we have to multiply all the cash flows with the probabilities to arrive at the expected initial investment and expected net cash inflows, and then expected salvage value. Same they have done 4 lakh, then 3 lakh 45. This is after discounting. Here they have taken for 1 to 4 years annuity factor, then 5th year separately as we have a salvage value, and we are getting an NPV of 39,922. Then the next requirement is best case and worst case NPVs. So best case is where we have more cash inflows, which will be this, and worst case will be this. So taking those, we have to calculate NPV separately for this 0.2 probability and 0.3 probability, in which we are getting negative 8580 for worst case, and in best case it is 92,060. Then going up next, the probability of occurrence. Same thing, in case of worst case the probability is 0.3, and for perfectly dependent over time, this is perfectly dependent over time, this is independent, perfectly independent over time. Then coming to the next requirement, standard deviation and coefficient of variation. Assuming that there are only three streams of cash flows which are represented by each column of the table with the given probabilities. So they are asking us to calculate based on three streams of cash flows. So how will I get the three streams of cash flows? By calculating the NPVs for the three scenarios. So NPV of this 0.3 probability, which is the worst case, and the most likely scenario of this 0.5, then best case of this 0.2. After calculating all the cash flows, then multiplying it with the probability, we'll get the expected NPV. Using that expected NPV, we have to calculate standard deviation and coefficient of variation. So they have done the same thing. Since in the second requirement we have calculated for best case and worst case, they have calculated for the most likely case, which is 47,950. Then multiplying the NPVs with the probabilities, will get expected NPV. Then using that expected NPV, we'll find out the standard deviation and coefficient of variation. So we got a standard deviation of 35,800, which if we divide by the expected NPV, we'll get 0.9 as the coefficient of variation. Now coming up to the next requirement, coefficient of variation of X Limited on its average project, which is in the range of 0.95 to 1. So they are telling in their other projects the average coefficient of variation is between 0.95 to 1, and they are telling if the coefficient of variation of this project is found to be less risky than average, 100 basis points are deducted from the company's cost of capital. So the current cost of capital is 10%. They are telling the whatever we got, like which is 0.9, if it is less than 0.95 to 1, then we have to reduce 100 basis points. So this basis points is nothing but 100 basis points will be equal to 1%. 1000 basis points will be 100%. So in our case, since the coefficient of variation is less than 0.95, we can reduce 1% from our cost of capital, and then we have to find out the NPV. So we got 10% minus 1%, which is 9%. Then we can proceed with the NPV. So the same first requirement, expected cash flow, we can take the net cash flows, and then we have to discount it with the 9% present value factor. We'll get a NPV of expected NPV of 51,960, so which is positive. Therefore we can accept the project. In this case, they have asked should the project be accepted by X Limited. They have not clearly defined on what basis we are accepting the project, but most likely we can say after meeting this criteria the NPV is positive, so the project can be accepted. Thank you.